Welcome back, everyone. This is the Kingscrowd Podcast. My name is Brian Belley from Kingscrowd, and we, as always, are joined by our two incredible senior investment associates, Léa Bouhelier-Gautreau and Teddy Lyons. Welcome back. Well, we have a great show planned for you today, and just hope everyone's doing well after, if it applies to you, Father's Day weekend. Teddy, I see it looks like you got a little golf polo on there. I don't know if you were watching the Masters at all, but, good relaxing weekend, hopefully for most people. Now, last week, before the weekend, Kingscrowd was in Atlanta, and we're going to be giving a quick update on just that in-person IRL event and how that went, some of the companies that were pitching. In addition, in the second segment today, we're going to be doing a very good and very interesting deep dive into repeat issuers in the online investment markets in equity crowdfunding. So Léa did a deep dive, took a look at companies when they are raising, how they go from platform to platform, how they're using different funding platforms, and we have a lot of good insights and takeaways there. Let's jump into the first part. Last week, both of you, Teddy and Léa, were able to travel to Atlanta, had a good little group, good get together, and had some companies actually fly in and pitch live. Why don't you kick things off? Teddy, give us a little overview of just what the event was and how it went.
Yeah. So first of all, it was the U.S. Open, not the Masters, but it's okay. I'll give you a pass.
Sorry. I'm showing my golf knowledge there. Yep.
But yeah, so Léa and I were in Atlanta for the Kingscrowd Startup Showcase. It was definitely Kingscrowd first time having an event in Atlanta, but it was personally my first time in Atlanta. And just a quick note before we get into some of the companies, it was interesting to see how much the kind of startup ecosystem there has kind of blossomed over the years. I've kind of always been kind of following it from afar, but one of the investors that I had dinner with afterwards, he exited a company that he grew in Silicon Valley, and he was saying that the mindset of entrepreneurship in Atlanta is so much different, where it's much more collaborative and founders always trying to help each other out, make introductions. Whereas in Silicon Valley, because the competition for capital there is like so intense, because so many tech startups are concentrated there, that the mentality of founders there is far more standoffish and competitive, and just kind of really the opposite of Atlanta. So I'm going to be curious to see kind of how that attitude changes in Atlanta as more and more capital flows into that city, because it's growing very fast, and a lot more venture capital firms are popping up there. A lot of tech firms getting founded there. So that was just a side note I thought was interesting. I've never been to Silicon Valley, so I'm just going off of what founders tell me, but and investors and all that. But yeah, it'll be interesting to see.
So who did we have in Atlanta? Who are the companies that flew in and pitched?
Yes, so we had 4 Kingscrowd Capital companies, which was awesome. So we had Doc2Doc Lending, who that's their founder is Dr. Zwade Marshall. He's an Atlanta-based entrepreneur. And for those of you that don't know, Doc2Doc, we've talked about it before, but they basically provide personal loans to doctors and kind of have a whole underwriting algorithm that takes into account kind of future earning potential, depending on, if you're first year in residency, kind of whatever your specialty is, you're pretty much guaranteed to get a certain salary in the future. So they're able to underwrite that risk into giving you your rates, whereas most kind of traditional personal loan lending companies don't take that into account. He's a physician himself, so kind of a great CEO for this business. And a lot of the questions on his pitch were about, once they underwrite a loan, do they then sell it to a bigger bank? Do they make money from servicing the loan, or just by kind of selling them in that type of transaction to a bigger bank? The answer is both, but but that was a super interesting one.
I think, Léa, you had covered another company, Rise Robotics, if I'm not mistaken, that was a past deal. They were there in person. You want to tell us just any key takeaways or anything from their pitch that you found interesting?
Yes, the CEO, Hiten Sonpal, joined us as well from Boston. And it was like the very first pitch that we had at the showcase, but really got a lot of interest. from people in the room. So Rise Robotics is inventing a replacement to hydraulics. They call it beltronics, and it allows for electrification of heavy machinery. I think that most questions really were related to the company's go-to-market strategy, which products are they going to launch first, and what are the expectations. And this is very relevant because the company is actually at this very decisive and exciting stage where it's about to launch its product on the market. It has a partnership with a manufacturer called Anthony Liftgate to be able to produce electrified lift gates. And so there was a lot of interest. Another company that I've already seen pitching before is Healthcare Originals. So I was in Los Angeles for the Super Crowd LA event about a month and a half ago, and we had a pitch competition, the Healthcare Original pitch, and won the pitch competition. So it was great to see Sharon pitching again. She's absolutely great at it. What Healthcare Original does is that they have that kind of small device that we can see right here that people with asthma or COPD can put on their bodies, and that allow them to follow kind of on their phones the state of the respiratory system. And that helps them prevent and manage respiratory attacks, which unfortunately can happen a lot and can be very dangerous for people with asthma and COPD. So another great and exciting company. The last one was Vegetable and Butcher. I know that Teddy likes them a lot.
Yes, so Vegetable and Butcher, that's our most recent Kingscrowd capital investment. Yeah, basically a kind of a local food delivery company similar to, well, I should say not similar to kind of Factor, which is a nationwide meal delivery service that kind of has a lot of preservatives and mold inhibitors and kind of that kind of nasty stuff in it because they distribute to nationally. But Vegetable and Butcher, they're localized to the Maryland, Virginia, and DC areas, and they have a very large facility that allows them to basically have 100 million in revenue capacity in that new facility and allows them to deliver up to 8 hours away. So while it is still a very local company, you can kind of see the unit economics of it are pretty phenomenal. They have 2,500 active subscribers that get meals on a weekly basis, and they're at a $10 million run rate. So that kind of shows you like this kind of starting local, and eventually they plan on building more hubs kind of in other regions of the country, but clearly a very lucrative model, and the unit economics are quite strong here. So that was the reason we made a rare investment into a food company that has a really strong financial profile. So yeah, he had a great pitch. A lot of the questions on his were around kind of the competitive landscape and how there are these big national players. But I think when you compare it to the Factors of the world, it actually makes the opportunity even more compelling, given how strong and how big they've gotten just in this really kind of localized approach. So yeah, it was a great one.
Awesome. Yeah, I'd say for anyone who does want a deeper dive, I think we've covered most of those companies in past podcast episodes. So feel free to check out some of the past pods, some of our past deal reviews. And then, of course, we have the reports that are published on the site for any of these that were top deals, that were Kingscrowd Capital Fund investments. You can read the analyst reports on those that are written by Léa and by Teddy. So lots of good research goes into those. We do a lot of diligence, a lot of talking with the founders. And then, as you can see, the founders really see Kingscrowd as a valuable resource, a valuable network for them as well. So also, if anyone's watching this and you're like, hey, when's Kingscrowd coming to our city? Let us know. We want to do some more in-person events like this. So definitely let us know what city you're in. If there's any companies, especially that are local to your city, that are raising capital online, that are doing well, it just helps to make the case of making it worth it for a trip for our team to go there. So we love to meet our customers, our investors in person, the founders, people raising capital. So feel free to leave us a comment, let us know for sure. Any other final remarks before we move on to the next segment? All right. Well, with that, let's move on to the chart of the week this week. So I'm going to turn things over to Léa, but we took a look at issuers and platform switching between multiple rounds, not only from second to third, but onward. Léa, give us a quick overview. What are we taking a look at, and what are some of your takeaways from the data that you analyzed?
If you're investing online since a couple of years, you probably have seen some interesting startups raising several rounds, maybe 2, 3, 4, it can be up to 13 actually based on the data. So what we try to understand this week is, are issuers switching platform between rounds? The chart that you're seeing right now is showing you on the first column the original platforms that these issuers chose on the first one and where they moved to on the second round and where they moved to as well on the third round. And so what is very interesting here and what kind of surprised me, I was expecting more issuers to be switching between platforms. But what happens, especially when you look at Wefunder and StartEngine data, is that companies tend to stay mostly on their original platforms, and the switch is not really that obvious. A little difference is that I feel that companies are switching more from Wefunder to StartEngine than from StartEngine to Wefunder. So 44 companies went from Wefunder to StartEngine, and 17 companies went from StartEngine to Wefunder. To put a little bit of context, this is only showing equity crowdfunding data from RegCF and Reg A+, but this is showing all-time data of the entire history of the equity crowdfunding market, which means that on the first column, you may have companies that did the first raise in 2018, in 2019, or in 2024. So it's very important, and that's kind of why we see really a variety of different platforms on the left. So Seed Invest, for example, does not exist anymore. It was acquired by StartEngine, but you can still see the impact that it used to have a couple of years ago, and you still see that companies had a lot of runs on Seed Invest at the very beginning. I have a lot of takeaways from that, but maybe Brian, Teddy, you have some things that you want to share first.
Teddy, what do you think? I know you look at a lot of deals. Is this kind of ringing true with what you're used to seeing, or any key insights from you?
Yeah, it's interesting because I think a lot of founders that are looking to raise again, they think, and I also thought this too until I talked to a few founders, but they think that, if you start on one platform, you get access to that entire base of investors that use that platform. That if you switch to another one, so if you go StartEngine to Wefunder, then that's like a whole new base of investors that you can hit and you can raise the same or more. But the more I talk to founders, I had one very notably recently tell me that the difference in investor base isn't that much different. They're like, for us, like as investors ourselves, we look at all the platforms, especially the two biggest ones. And like the overlap, I think, is bigger than founders actually think. So yeah, I'm actually not as surprised to see kind of StartEngine founders kind of stay on StartEngine for their second one, Wefunder to their second one. There are some founders that clearly have tried to go to the other platform, but I think more and more are realizing now that it's not necessarily about the investor bases on the different platforms. It's really about, you need to do what you can to draw traffic to your raise, no matter what platform you're on, whether that's through ads or kind of just bringing in your own community, customers, things like that. So
yeah, so one of the things I immediately thought when we were thinking about looking at this chart is, I'd be interested to see, do companies tend to progress from more of like the marketplaces? And when we say marketplace, it's like the Wefunders, the StartEngines. They're very open. You can see all the other offerings on the platform, versus more of the broker-dealer model, which tends to be more on like DealMaker securities, where you get a landing page. You can't necessarily go to DealMaker and see all of the DealMaker deals in one place. But broker-dealers tend to service more Reg A deals, later stage deals. And so my suspicion was, maybe as time went on through more and more platforms and more funding rounds, that they might move to more of the broker-dealer platforms like DealMaker, which you can see a little bit here up through the third round, at least as a percentage of all of the third round companies. DealMaker is bigger. But Léa, did you notice anything like that in the data when you were looking at it? And I know you actually looked at a few other ones also from like rounds 3 through 5 and even all the way up through 7 subsequent rounds.
On the very first one that we have here, only 12 companies, so 1.52% of the deals, are on DealMaker. As soon as you move to the second round, it doubles. 3.68% of the deals are on DealMaker. And when you reach round 3, actually 11.11% of the deals are on DealMaker. So now if you go to the other chart, that kind of shows what happened rounds 3 to 4. So round 4 already, we have 14.81% of the deals on DealMaker, and round 5, 17%. If you go to the third and last chart, you can see that we have about 21% of the deals that are on DealMaker for the sixth round. So the share of DealMaker really increases in time. And for me, there's two reasons to this. The first, as you said it, Brian, is as companies mature, they maybe have more marketing budget and they will be better fitting in a model like DealMaker Securities, where spending on marketing is important, and because there's no marketplace. But I also think that it's an evolution in time, because DealMaker is a way more recent company. It's a company that we saw booming really in the last 24 months, I want to say, from my own take. And so it just makes sense that in order for you to reach round 6 or round 7, you need to have been around for a while. And these are probably way more recent raises that number one raises, which span from 2018 to 2024. So it makes sense. Another thing that I see is that Wefunder disappeared at round 7. And StartEngine is kind of getting a biggest and biggest share of the market as companies try to raise subsequent rounds.
Yeah. And that could, again, so when we talk about broker dealers, that's a type of crowdfunding platform, of crowdfunding intermediary. Funding portals are the other type. Wefunder is a funding portal. DealMaker and StartEngine actually has both a crowdfunding funding portal as well as a broker dealer arm. DealMaker tends to use their DealMaker arm for a lot of their deals, but that could potentially be one thing when you're going to the broker dealer model, rather, is, some of those companies that are doing 6 or 7 or more rounds. I just pulled up one here that is probably familiar with a lot of people, but Boxable. I lost count here how many companies, how many rounds this is, probably like 10, but you can see they jumped from Wefunder, StartEngine, Republic, StartEngine, DealMaker, StartEngine, DealMaker. So all these latter ones here tend to be more of the broker dealer. And obviously that's, once they're raising much bigger sums of money, as Léa was saying, they probably have more to be able to afford the disclosures and the more financial rigor that's required for audits for a Reg A offering, as well as, also having more marketing budget to be able to invest. So that could definitely be a part of it as well. I will say this, sometimes, if you're hiring, if you've done hiring at your company before, right, you might look at resumes and say, ooh, this person's jumped jobs a lot, like in the past few years. Maybe that's not necessarily a good thing, right? They couldn't really hold a job. Do you think it is a negative signal if you've seen a company that has raised on a bunch of platforms?
No, that's actually something that I was expecting personally, to see companies switching more. One of the reasons for that is some platforms have subscriptions. So I know that StartEngine has a subscription program that allows investors to get bonus shares. So I'm thinking if you want to get that whatever percentage of StartEngine investors that are subscribing to StartEngine and probably favor StartEngine deals, you may want to switch platform. I also think that platforms sometimes have just themes and feels that are very different. So if you feel like you stick to one platform, yes, maybe you can switch to that. But if you want to change your narrative and maybe present yourself in different ways, it can be interesting to switch. I also know that the way that platforms are managed are completely different. For example, on Wefunder, you're way more free to build your own race page. On StartEngine, you're way more guided by the team, by the StartEngine team. So it depends on the service that you want to get. Personally, I don't think that platforms, especially if you think about the biggest one, matter that much. I've seen companies being extremely successful on a variety of platforms, and we have other charts that kind of tell founders, oh, all right, if you was on Wefunder, this is the median amount you're expecting. This is really on StartEngine, this is the amount you're expecting. But what we see is that it's really a company per company deal. And so I will try to maybe get a good deal from the platform. Maybe you can negotiate the rate. And that can be maybe more interesting for you to work with different people to see if you can tailor your message in a different way, if you can get different types of advice, and maybe try to reach capitals that you just couldn't get before.
Yeah, lots of nuances to get into, and I agree with everything you said. And make sure you, I won't say shop around, but talk with the different teams, right? Just different founders might get along with different platform teams differently. Again, they offer different things, right? On the back end, some of them might have more seamless processes for going to their transfer agents if they have a transfer agent, or some of them have secondary marketplaces if that matters. Like Léa mentioned, some of them have these VIP membership programs where investors get bonuses for investing, like bonus shares. And some of them have different, I will say, approaches in terms of just marketing, right? In terms of how much of your own marketing data, customer data you own, that sort of thing. So any last remarks, Teddy?
For new founders, when you're evaluating all the platforms, I mean, you'll see pretty quickly that StartEngine is the most competitive. There's kind of a deep kind of due diligence that happens before you get on StartEngine. And the process, like Léa said, is a lot more high touch, where they're going to be encouraging you to run meta ads, for example, for your raise page. Whereas Wefunder is like a lot more, it's less competitive in the sense that they're more open to the type of company, whether it's a mom and pop shop or a high growth software company. They're a bit more open to letting, really democratizing access to this space, but they're going to be a lot more hands off, at least from what I've heard, a bit more hands off on kind of driving capital to your raise.
There are thousands of companies that raise for the first time. Only 787 actually raised for the second time, and only 237 companies raised for the third time. So if you're an investor and you see a deal that is interesting, I wouldn't assume that this company is going to raise a second or a third time. I will try to invest at an earliest valuation when I can, even if it's risky. But I would love to see more and more companies in the future raising rounds again, because then as an investor, it's very exciting for us. We can really see and follow the progress of these raises and see whether our initial thesis was right, whether we were wrong, whether there are progress that are surprising. And I know that if we think about a company like Kinetic, for example, I know it's a company I personally invested in on their first round, and that was a very risky bet. And now that we've seen them again, they actually hit on all of their promises. They executed well and quickly. And that's one of the biggest factors that made us make an investment decision, even if it's still a very risky deal because it still has an early stage. They demonstrated in real time the execution capabilities. And so that can be a really, really good tool for founders who want to raise again, to make sure that they have enough progress to show to convince investors to invest more money into their deal.
Awesome. And for any potential investors out there, when you're looking at these companies, if you want to know if they've done prior funding rounds, we capture all of their funding round history for any online funding rounds. You'll see it. There's a drop down at the top where you can link to multiple funding rounds. But if you scroll to the bottom of any deal page on kingscrowd.com, you can see all their funding rounds. And we also have growth charts. So if these companies are growing their revenue round over round, changing their valuations, the number of employees, price per share, we track all of that round over round. For example, if I go back to the Boxable one, right, you can see the valuation increase over time as each funding round progressed. So this is one way that Kingscrowd aggregates this data and makes it just more accessible, easier to digest, so that all of that data is at your fingertips, so that you as an investor can make a more informed decision when you're trying to decide whether or not to invest. I think that's a great place to wrap things up. Again, thank you everyone for joining us. We absolutely appreciate all the time that you spend interacting with us, watching these episodes, these podcasts. If there's any other topics you want us to cover, feel free to let us know. And if you haven't already, please do head over to kingscrowd.com. You can also sign up. We have a free weekly newsletter where you'll get all these great charts of the week. Thank you, everyone. We'll see you back here next week.